All right, we need to talk about what's happening right now in gold, and more importantly, what's happening behind gold. Because at the time I'm recording this, gold is sitting around 49.66 an ounce, up just under 4% over the last 24 hours. And silver's up even more, around 9 to 10%, back in the high $70 range. That combination matters. When both metals are ripping at the same time, it's usually not just a nice day for commodities. It's usually a positioning event. And today's story is simple on the surface, but intense underneath it. Money is flowing into gold and precious metals ETFs again, and the flow is big enough that it's starting to change the market's behavior. The real question is, are these flows the start of a second wave higher, or are they the final trap before another violent shakeout? Stay with me, because I'm going to break down three things that collided, why ETF money is the hidden accelerant, and what this could mean for your portfolio over the next couple of weeks. Here are the three factors that converged today. First, the paper gold doorway just got crowded again. When most people hear gold ETF inflows, they think it's just investors casually buying an easy ticker symbol. But ETF flows are more than a headline. They're a mechanical force. When a major gold ETF takes in billions of dollars, that doesn't just sit there as a number on a screen. It creates demand pressure that has to be hedged, sourced, and balanced by institutions that actually touch the underlying market. And Reuters just highlighted that investors poured billions into gold and precious metals ETFs recently, including large inflows into the biggest funds. That matters because inflows don't arrive politely. They arrive in waves. One day it's a slow trickle. Then suddenly you get a week where it feels like everyone shows up at once. Retail, advisors, macro funds, even people who swore they'd never buy gold because it's a barbarous relic. And when that wave hits during a thin liquidity environment, where the market is already jumpy, price doesn't move smoothly. It gaps, it whipsaws, it squeezes. That's how you get gold up nearly 4% and silver up nearly 10%, and everyone on the internet feels like it happened in 5 minutes. Second, this isn't just gold investors. It's fear capital looking for an exit. A lot of the money going into gold ETFs isn't coming from people waking up excited about bullion. It's coming from investors who don't trust the stability of the rest of the board. They're looking at policy uncertainty, leadership uncertainty at the Fed, rate cut expectations, dollar direction, geopolitical risks, and they're trying to park capital somewhere that doesn't feel like a promise from someone else. That's what gold is in people's heads, the asset that doesn't need permission. And when that psychology turns on, flows can keep coming even after price spikes. That's important, because it means you can't just say, gold is up, so it must reverse. In flow-driven moves, price can keep climbing simply because the money hasn't finished moving yet. Third, silver's behavior is screaming forced positioning, not normal trading. Silver doesn't move like gold. Silver is the metal that exposes leverage. When silver is up almost 10% in a day, especially after the kind of volatility we've seen recently, that's often a sign that somebody got pushed out of a trade. It could be short covering, it could be margin pressure, it could be liquidity vacuums. But silver doesn't usually do gentle. Silver does violence. And when silver is acting like that while gold is catching aggressive inflows, it tells you the same story. The market is being repriced, not politely valued. So that's the setup. ETF money pushing, fear capital rotating, and silver revealing stress in positioning. Now let me stack the evidence, because this is where it gets real. Smart money moved before the crowd noticed. Let's start with the institutional behavior, because ETF flows are basically a live scoreboard of investor psychology. When Reuters says billions flowed into precious metals ETFs and highlights big inflows into major gold funds, that's not a random detail. That's the footprint. And here's what most people miss. ETF flows don't just reflect price, sometimes they lead price. When flows accelerate, it can create a self-feeding loop. More inflows push price up. Price up triggers breakout buyers. Breakout buyers create headlines. Headlines bring in more inflows, and suddenly you're not in a valuation market anymore. You're in a momentum plus fear market. Now, I want to be very clear. ETF inflows don't guarantee higher prices tomorrow morning, but they do tell you something extremely important, where investors are choosing to hide and what they're willing to pay for that hiding place. If you're a regular person watching this, you might be thinking, okay, but why does an ETF matter to me? Here's why. Because the easiest access point for mass capital is ETFs, retirement accounts, advisors, institutions that can't or won't buy physical, allocators that need liquidity. They buy the ETF first, and when that door opens, the entire narrative around gold changes from niche hedge to mainstream allocation. That shift alone can move markets for months, not days. Now let's talk technicals in plain English. I analyzed the price action, and what jumped out at me is how these moves are happening in chunks, not steps. Gold around 49.66 with a near 4% daily move is not a sleepy, orderly climb. That's repositioning. And silver around 77.69, up nearly 10%, tells me volatility is still the environment, not the exception. So what levels matter? Here's the way to think about it without charts. When a market makes a violent move, the most important thing isn't the exact high. It's whether the market can hold the new normal after the excitement fades. For silver, that means one big question. Can it stay in this high 70s zone, or does it fall back into the mid 60s where it was recently panicking? Because if it falls back hard, that tells you today was a squeeze, not a reset. But if it holds and consolidates, if it stops crashing every time momentum fades, that suggests something more structural is happening. For gold, it's similar. Can gold hold near this level after the inflow wave slows, or does it immediately give it back? Flow-driven moves often retrace, but they don't always retrace all the way. And that's where people get trapped. They wait for the old price that never comes back, because the market found a new base while they were waiting. Now let's talk fundamentals, because this is where the narrative becomes bigger than a one-day move. The fundamentals are basically the reason investors keep coming back to gold even when it feels expensive. Gold is not priced like a normal commodity. It's priced like a vote on stability, a vote on credibility, a vote on whether money tomorrow will feel like money today. And when investors start expecting rate cuts or start worrying that policymakers are stuck, meaning inflation is sticky but growth is fragile, gold often becomes the default hedge, not because gold pays you, but because gold doesn't need someone else to perform for you to keep value. Now add the global context. You've got central banks still accumulating gold. China's central bank, for example, has been extending its buying streak, so you have two forces pushing in the same direction. Official sector demand in the background, investment demand showing up through ETFs and momentum. That's when things can get unstable on the upside, because supply doesn't instantly respond. And that's also when dips can become shallow, because every pullback becomes a second chance to allocators who missed the first move. Which brings me to the part that most people don't want to hear. If this really becomes a flow cycle, the most dangerous moment isn't the beginning. It's the middle, when everyone starts believing it's safe, and leverage quietly returns. That's when gold can look calm while silver becomes absolutely unhinged. And if you've been in metals long enough, you know exactly what I mean. We've seen this exact pattern before. Think back to 2020, not because the world today is identical, but because the psychology is familiar. In early 2020, the world flipped from everything is fine to I need liquidity right now. Gold sold off at first because margin calls force people to sell what they can, not what they want. Then something changed. Central banks and policymakers opened the floodgates. Rates collapsed, real yields fell, money creation exploded, and gold didn't just rise, it repriced. But here's what's important. The move wasn't smooth, it was jagged, it was emotional. Gold would surge, then pull back, then surge again. Silver was even more extreme. Silver would lag, then explode, then crash, then explode again. And the people who got hurt weren't just bears. A lot of the damage happened to bulls who used leverage or chased the move at the wrong moment. Now compare that to what we're seeing now. We're in an environment where people are hypersensitive to Fed signals, leadership, dollar direction, and the idea that the next policy turn might come fast. And when that expectation grows, gold becomes the place to front-run the narrative. Meanwhile, silver becomes the stress test. Silver is where paper positioning gets punished, because silver is smaller, thinner, and reacts harder to forced buying or forced selling. So when you see silver up almost 10% while gold is up around 4%, the message isn't just silver is strong. The message is positioning is unstable. And when positioning is unstable, the next move can be violent in either direction. That's why I'm not here to hype you. I'm here to tell you the truth. This market is offering opportunity, but it's also offering traps. And the difference comes down to how you're positioned and what time frame you're actually playing. Let's make this personal. Let me show you what this means in real dollars, because percentages don't feel real until you translate them into your life. Scenario 1. You own a typical portfolio, maybe stocks, maybe bonds, maybe some cash. And you've been watching inflation, rates, and volatility make everything feel unstable. So you decide, I want to hedge. Most people don't buy physical first. They buy the ETF because it's easy. Now imagine you put $10,000 into a gold ETF when gold is around 49.66. If gold moves another 5% from here, just 5, your position could gain about $500. That's not life-changing, but it is meaningful if it's doing its job as insurance while other things wobble. Now look at silver. Silver at about 77.69, up nearly 10% in a day, shows you how quickly a small allocation can swing. If you had $10,000 in a silver position and silver moves 10%, you're up about 1,000. But, and this is the part people ignore, if it swings the other way, you can lose 1,000 just as fast. That's why silver is not a casual hedge for most people. It's a volatility instrument, whether you like it or not. And here's the second scenario that matters even more. What if you don't own metals at all? Then the real impact isn't that you missed a rally. The real impact is what metals are signaling. When gold and silver start acting like this, they're often front-running something else. Stress in currency confidence, stress in policy credibility, or stress in liquidity. You may see it later in stocks. You may see it later in credit. You may see it later in consumer prices. But metals often move early because they're the most sensitive to trust. So even if you never touch gold, you should care when gold starts pulling in billions through ETFs, because that tells you where capital is seeking shelter. And the last piece here is psychology. When headlines start saying, investors are flocking to gold ETFs, that's when your neighbor asks about gold again. That's when advisors who ignored it start pitching it as a prudent allocation. That's when retail arrives after the easy part already happened. So the window isn't about panic buying. The window is about being thoughtful before the crowd gets emotional. Look, the question isn't whether we see more volatility. The math is clear. When ETF flows turn on and central banks are still buying and the market is already fragile, you should expect sharp moves up and down. The real question is, are you positioned for what comes next? Because there are two very different paths from here. One path is that this is the start of a new base, meaning gold holds near these levels, ETF flows continue, and pullbacks get bought quickly. The other path is that this is a late-stage squeeze, meaning price spikes, retail chases, and then the market hunts liquidity again with another violent flush. In the near term, what happens next is less about your opinion and more about whether money keeps flowing. And right now, gold is around 49.66, silver is around 77.69. Those are not quiet numbers, those are attention numbers. I share real-time updates and deeper analysis on social media. For those wanting exclusive research, members-only analysis, or early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations, but the data tells the story. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from. And give me your prediction. Where do you think gold is headed by the end of this month? And where do you think silver lands first? Back in the 60s? Or does it hold the high 70s? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype, so the algorithm knows you're here for the original. 3, next video drops soon and I'm covering the one data point most people are ignoring that tends to show up right before these metals make their next violent move. You won't want to miss it. See you there.